Okay. Nice to meet you all again. Today we can have our kind of revision sessions. It can be shorter than 3 hours. We can finish a little bit earlier if you don't have any questions after my revision sessions. Okay, what I'm planning to do is to give you one more time an overview of each chapter or each modules, and then a little bit revise, make a revision for what are the main concepts that you I would expect you to know, and then obviously you would probably expect also that you're gonna see in the exam. Okay, the exam we're gonna be, if I'm not wrong, Lynn, we're gonna make it online, so I gonna be able to send the final exam to the CFVG, to Lynn and the team by beginning of next week. So if I'm not wrong, you can have your exam on 24th of October. So, uh, I guess that this tutorial section or this revision would be helpful or useful for you to recap the main concepts we have learned in our class. So it's quite a while ago, so some of you may be already uh, forgotten what we have studied. All right. So I would start with the concept of each and try to go relatively fast so that you get the main idea. I will not repeat the lessons for all, but I just want to summarize what are the main lessons or a concept that you need to understand, and uh, you know um, we're gonna evaluate based on those concepts. Okay, all right, you ready? Yes. Yes, okay, perfect. So I have only 21, including myself and Lynn. So I have only 19. So hopefully other people will join us soon. All right. So let me start by what we learn in these financial structure and strategy class. So we learn basically some of the concept that starting from risk and return, optimal portfolio choice, and the CAPM capital asset pricing model to estimate cost of equity capital, and then we learn how to compute the firm's cost of capital, how to calculate WACC weighted average cost of capital based on the calculation of the RD, RE, and then the weight on the capital structure where the firm or the company decided to have some of them in their capital. Some of them are equity, some of them are debt, and then the blend of the two will give you the capital structure, and this capital structure will be used to calculate the weighted average cost of capital. All right, something like that. All right, and then we learn on the capital structure theories, starting from Martin Miller, and then in the perfect capital markets, and then we introduce taxes, and we introduce some of other market frictions, including benefits and also associated cost. All right. Oops. So I haven't started anything, so therefore you don't have these. Okay, let me see how. You see my slides? Yes? Okay. So let's start by revising what we have learned in the first part, which is called risk and return. The risk and return, okay, as we know that high risk, high return, and the idea of these, the first part is to introduce you how we measure the return, how we measure the risk, how we measure expected returns, and how we measure the different type of risk. Okay, so that you can price it on your risky assets. So several type of risky asset, as you can see here. It can be stocks, it can be low market cap stocks, it can be corporate bond, it can be T-bills, and so on and so forth. So to be able to calculate the expected return, so expected returns, as you know, that we have to address the uncertainty on those possible returns. So we use your high school mathematics on statistics and use the probability or the distribution of the possible return. So therefore, you can calculate the expected return based on the weighted average of the possible returns where the weight corresponds to probability. Okay, so this is the way we calculate expected return. Very straightforward. All right. So and then when we would like to know how to measure the risk, the first one that we measure, we called it as the total risk. The total risk represent the, you know, uh, volatility or how the spread out of the distribution of the return. So we measure it in the form of variance. We take the square root of the variance. We call something called the standard deviation, and the standard deviation is the square root of the variance, and this standard deviation of returns is referred to its volatility. So when we talk about the stock return volatility, it means that we measure the standard deviations of the possible returns. All right. So these are the formula. You have it, and then we learn how we calculate the expected return and volatility. This one you can revise it by yourself. And then obviously, if you have this kind of probability and you have the possible returns, which are quite difficult to determine. So what we can do is we can also use some historical returns of stocks and then calculate the historical average returns. The average return we can calculate in two ways. One we call arithmetic return, average return, and another we call geometric average return by calculating compounded annual returns of securities. And then you have the formula to calculate the variance, the square root of the variance. We also call the standard deviation. And this standard deviation is referred to stocks volatility. All right. So this is how we compute it. I will not going to show you the interesting part that we find some linear relationship when we have a large portfolios. We can find some linear relationship between historical volatility and the historical average returns. So interestingly, that when you go for individual stocks, the relationship is not so clear. No precise relationship between volatility and average return for individual stocks. But when you have a large portfolio, you can find that relationship. Okay. And then we investigate further and we know that the volatility of the stock is measured something called the total risk, where indeed these total risk can have two components. One, which is called the idiosyncratic risk, is the risk which is diversifiable way. So you can diversify this idiosyncratic risk, or we call unsystematic risk. And you have another risk we call systematic risk that represent these called undiversifiable risk or the market risk. Okay. And then we have already learned on what are specific to firm, what are the systematic or market risk. Okay, as you know that some of those most of those idiosyncratic risks can be diversified away. Do we need to get, or investor will get compensation to hold it? The answer would be no. Why? Because you can diversify away for free. So therefore, the idiosyncratic risk, okay, is the risk that investor will not get compensation. That might explain when you do the stock cherry packing, this is very difficult to beat the market portfolio returns. So diversification eliminate idiosyncratic risk, but does not eliminate systematic risk, because investor can eliminate idiosyncratic risk that do not require risk premium for taking it on. Because investor cannot eliminate systematic risk, they must be compensated for holding it. As a consequence, the risk premium for stock depend on the amount of the systematic risk rather than its total risk. So how are we gonna measure the systematic risk? That we're gonna be our next session or the next module. Right. So this chapter very straightforward, nothing's complicated. So you should know how to measure the risk, how to measure return, how to measure average return, how to measure, the the standard deviation that represent the stock's volatility. That's it. And then the risk, you know that when you measure volatility, you measure total risk, and total risk has two components. The one which is diversifiable, we call idiosyncratic risk, and the one which is not diversifiable, we call market risk and or systematic risk. So far, so good. That is the kind of revision. You see, nothing to prepare, right? You can write the exam tomorrow and everybody got 20 out of 20 because it's so easy. So far, so good. You all with me? We have 35 people now. That's great. Yes. Okay. So do you have any question? Please continue. Very good. Any questions so far? So you have problem set. The first chapter, everything should be straightforward, easy to handle. In the exam, I gonna have two type of questions. One is more conceptual questions, and another is gonna be more computation, problem solving questions. That makes sense? Okay. And the concept question that can be true, false, something like that. Okay, where the problem solving questions, I may have some multiple choice for you to pick it up when we do the online exam. Perfect. So far so good. You all safe from COVID? Yes. To false question explanation, sir. Please do make it so long because we have limited time. Yes. The exam will not be too long and it should be appropriate with the time you give. Lynn, can you confirm me how long it's gonna take for the exam? Is it 2 hours? What? Lynn, is it 2 hour exam? Yes, 2 hours. Okay. So, all right. So it's a 2 hour exam. So the exam you should finish in 1 hours in general. Okay, but you can stay for 2 hours. I will not make it long. All right, promise. Okay. If you don't have a question, you don't have question, so I can go for the second part or the second chapter, which is called optimal portfolio choice. That just demonstrates how the putting together in a portfolio or in the basket of the risky securities, some of the risk can be diversified away. All right. So that is how we learned it in optimal portfolio choice, which is the base to derive the capital asset pricing model. All right. Okay. T Chung Guyan, you raise your hand. You want to ask me a question? Go ahead. T Judong Guyan, you have any question? You can speak. No? You don't have any more question? No question? All right. Okay, if you don't, I continue. Make sense? So, the second chapter, which is called the optimal portfolio choice. Okay, what you need to do, what you need to know in this section. Okay, first, you should know how to calculate the portfolio returns. The portfolio returns would be based on the portfolio weights in, okay, with the return n, okay. If you have R1, R2, R3 until Rn, you have X1, X2, X3 until Xn. You just simply calculate the weighted average of these is gonna be your return of your portfolios, right? So this is how you should be able to calculate the portfolio returns, the portfolio expected returns, and very straightforward. Okay, on the portfolio return, you should know how to calculate the portfolio returns. Next, you're gonna know how to calculate the volatility or the of the two stock portfolios. Okay, so as it's shown here, that the portfolio risk, the risk of the portfolio depends upon the something called the correlations, okay, of the stocks inside that portfolios. All right. So because that is the way we calculate how the RI and RJ co-move. Okay, and we have a terminology which is called the correlation, and this correlation we're gonna be equal to the covariance of the RI and RJ divided by E standard deviation. Okay, this is a probably if you want to highlight the formula, you should know by heart. Okay, and then as we can see here that when the correlation is high, so therefore you can have less diversification benefits. When the correlation is low, you're gonna get more diversification benefits. As you can see that the the variation or the standard deviation of the portfolios from North Air and West Air is higher than the West Air and Tex Oil. So therefore, when you calculate the the volatility of North Air and West Air compared to West Air and Tex Oil, the West Air and Tex Oil will have lower volatility because you can gain more diversification benefits. What is a diversification benefit? The diversification benefit is the what is a diversification benefit? What is a diversification benefit? Anyone can help me to answer? What is the diversification benefits? What is the diversification benefits? It's avoid systematic risk. It's is a benefit that you can maximize your return without increasing risk, or you can have as the given level of risk, you can maximize your return. So it means the diversification benefits are the benefit that you can eliminate, not avoid, eliminate the unsystematic risk from your portfolios, right? You reduce the some risk, okay, due to the diversification benefits. Okay, so at a given level of risk, you can maximize your return, or at a given return, you can minimize your risk. Okay, and this one we call diversification benefits. All right. So if I have different ways to do on the my correlation and volatility of each stocks, I can be able to calculate the covariance and correlation that we see. Okay, this one is probably the slide that you should note it down, that if you have two stock portfolios, that is how we compute the return of a two stock portfolio, which is equal to the X1R1 plus X2R2. Whereas when you have these two stock portfolio, the exam, I will not go beyond two stock portfolio. So I will gonna use these, formula, and these slide number 16, you can probably note it down and see that you should be able to use these, or you're gonna use it several times, okay, to calculate the return of the two stock portfolios and volatility of the two stock portfolios. As you can see here, the variance depend on the correlation of the R1 and R2. If the correlation of the R1 and R2 is small, you can make these terms smaller. Okay. If the correlation is high, you're gonna make the variance is high. If the correlation of the R1 and R2 is negative, you're gonna be even, reduce further of your portfolio risk. That makes sense? Okay, so you can just simply revise some of those exercise we have done together. You should be able to calculate that if you want to form a portfolio that the variance is equal to 0, what would gonna be the X1, what's gonna be the X2 if the correlation is equal to -1. This is the only way you can calculate or find a portfolio where you can eliminate completely of your unsystematic risk. That makes sense? So if you have the large portfolio, as I told you, normally when you are the wealth manager, so you or you are portfolio manager, you're gonna be able to use some of those programming that allow you to compute, okay, the variance of or the volatility of your large portfolios. Okay, the interesting that you can see here that your portfolio, by increasing number of stocks in your portfolio, the volatility will go down until little level so that you cannot diversify it anymore. For example, you can see at 500 stocks in the US, almost the same at the level of the portfolio of 1,000 stocks. So therefore, the S&P 500, for example, is often used as the portfolio that has only market risk. Okay, so as you can see, that is a kind of proxy of well-diversified market portfolio with the S&P 500, for example. All right, so the concept is very straightforward. I think in two stock, you should know what is important slide. So it should be this slide, right? It is a way you should know how to compute the return of the two stock portfolio and the volatility of the two stock portfolios. Okay, that is, I think, the major concept for the first part on this chapter. The second part is about the definition of how to gonna choose the efficient portfolio, okay, what is the efficient portfolio? The efficient portfolio is a portfolio where you can simply maximize your return at the given level of volatility. For example, as you can see here, when you invest 100% in Coca-Cola stock, you need to, you're gonna earn only 7% of the level of 25 volatility. Whereas if with the same level, if you go and put 40% in Intel and 60% in Coca-Cola, you can have the same level of volatility, whereas you can maximize the return. So therefore, investing in Coca-Cola 100% is not an efficient portfolios. Okay, because you can find a better risk and return relationship when you go up to the point where you can see here. Okay, so that is how you should know how to modify and improve your portfolio returns at the for finding the efficient portfolios. Okay, this is the one I'm talking about. They're talking about that the correlation, and then the correlation the equal to 1, so you wouldn't get any diversification benefits, because the more you put volatility or higher return, you're gonna bear higher volatility. However, if the correlation of the two stock is not equal to 1, okay, and you're gonna be able to minimize your risk without sacrificing your return, where the correlation, when the correlation is equal to -1, you can get probably maximum benefits from diversification, where you can almost or bring it to the level of volatility of 0 without taking any risk. You can get this kind of return, and this point in the economy should represent the risk-free interest rate. Okay, so that is the second part on the concept of the efficient portfolios. Okay, now the next is how we're gonna be able to make the combination of the risk-free asset with the portfolio risky assets. So this way that you combine would can allow you to move and make the investment, which is easier to to find the best combination that you can maximize return as a given risk level. Okay, that is how we do this in the linear line that you can see here. Okay, so as you can see here, often we have the formula of expected return of this portfolio and volatility of these portfolios. Okay, so to be able to evaluate whether your investment combination is good or not good in relative to another portfolios. Okay, there is a kind of economist who proposed and got Nobel Prize, and they identify a portfolio which is considered as the best or the the efficient portfolio in the economy. Okay, the goal is an investor who seek to earn the highest possible expected return for any level of volatility. To find this portfolio that generate the steepest possible line when combined with the risk-free investment, the slope of this line is called the Sharpe ratio. Okay, you can see here, if the line going up, they going up, I mean steeper, they have higher slope, is better, isn't it? Okay, and to be able to measure this, we can calculate something, we can compute the Sharpe ratio, and this Sharpe ratio, okay, we're gonna help us to evaluate whether which portfolio provide a better on the all possibility investment of possibility you have. So the efficient portfolio can be also defined as a tangent portfolio is the portfolio with the highest Sharpe ratio. Okay, so as you can see here, the blue line is not the most efficient portfolio, and you want to get the tangent portfolio, you have to move up until you get the highest slope from these your investment choices. Okay, so this is how you should probably revise a little bit on how to form, how to find the best portfolio combination of the risk-free investment and the tangent portfolios. Okay, so you can revise a little bit, something like this. So some of the questions you would expect to see it, okay, in the exam. So this is a kind of third parts of this chapter, right? We have three parts, but we have already first part where we know how to form our portfolios, and then we learn how to, you know, calculate the two stock portfolio risk and two stock portfolio returns, and then you know how to combine the risk-free asset with the portfolio P, okay, and then you gonna be able to identify the efficient portfolio based on the Sharpe ratios. So far so good. See nothing to revise. Have you read and prepare your exam? Not yet. Okay, but I hope that after today class, everything is so easy for you, isn't it? Agree? It is easier now. It is easier. Yes. Hopefully. Hope so. Yes. Okay. Hopefully. So, as you can see, I think you have already learned and you have already understood before today. So once I refresh a little bit, it's easier for you to understand now. Then you know, and then you can understand very well just before the exam. Okay, just a day before the exam, it should be fine. You don't need to understand everything now, but before exam, you should. All right. Okay. Now, next part, which is the last part of this chapter, we're talking about what? We talk about the capital asset pricing model. What is a capital asset pricing model? Capital asset pricing model is the model that allow you to derive your relationship, the relationship between a risk and return of individual stock. All right. So you have some assumption that we're not going to talk about here. The most, I think, important and the key element for this is that the CAPM identifies the efficient portfolio as the market portfolio. Basically, so you assume that the market portfolio, such as S&P 500, represent an efficient portfolios, and these efficient portfolio would allow you that these line, or we call it as a capital market line, okay, would be the line that touch something called the efficient portfolio, or these efficient portfolio is referred to market portfolio. It means the each individual stock, if you believe that all investors were gonna try to eliminate idiosyncratic risk away and they're gonna hold only systematic risk, you're gonna be able to convert, you transform your, for example, ExxonMobil, okay, by having what we call the security market lines. Okay, as you can see here from Exxon, okay, where you plot the graph of volatility, which is the total volatility and the expected return, you can cross the line and try to reach the point where you can touch the market efficient portfolios. And this one, okay, we're gonna make it possible and measure in the form of systematic risk that we define it as the beta. And this beta would allow you to derive that the ExxonMobil, when they have the beta of what, you're gonna be able to calculate the expected returns. Okay, and the CAPM assume that all the financial security in efficient market, stand or stay in the security market line. You can see that all these can be converted into the security market line. All right, and these security market lines show the required return for each security as a function of its beta with the market. According to the CAPM, the market portfolio is efficient, which is equivalent to the required return equaling the expected return for every security. According to the CAPM, all stock and portfolio should lie on this SML line. Okay, so let's come back how we define the to compute the market risk. So this is probably this slide, if someone want to note it down. Okay, you don't want to lose your time to search formula, and this one, it can be an important formula that you should know, and then we can evaluate your understanding of this formula. The first, the above one, this one, represent what? Represent the CAPM, the CAPM, okay, where it says that the expected return of the stock I would be equal to the RF plus beta I multiplied by ERM minus RF. The only mistake I have seen is is about that the definition. Be careful when you have ERM minus RF, we call it as the what? ERM minus RF, how would we call it? How do we call it? ERM minus RF, how we call that one? No, it's not it's not the risk premium. More precise, what is that? How do we call it? We call is a risk premium of what? It's a market risk premium. Thank you, Tong Nguyen. Okay, it's a market risk premium. It means the excess return above the risk-free rate that you were gonna expect to get if you invest in the market portfolio, right? The ERM represent what? Expected market return. Okay, market's expected returns. Okay, so and once you have market risk premium, you multiply by the beta, you're gonna get what? If you have the beta multiplied by the E beta multiplied by the ERM minus RF. Okay, how we call that one? You're gonna get it. How we call this one? The beta I multiplied by ERM minus RF. How we call this one? Expect the return of the security I. No, almost. It is the it's not the expected return of the security I. It is when you take the beta multiplied by the market risk premium, what you're gonna get? No, not the market risk premium. It's the risk premium of the security I, right? It's a security I risk premium. It's a risk premium of security I, isn't it? Right? Because you know the amount, the level of systematic risk or the market risk that you measure in the form of the beta. You multiply by the market risk premium, you're gonna know the risk premium of the security I. And then if you want to know the expected return of the security I, Tong Yuan, how you gonna do it? So you can just simply plus the RF, right? So if I take the formula, you can see you can just simply have the RF plus beta I multiplied by ERM minus RF. Do you see something here? It's a risk premium for security I plus RF. You're gonna get expected return of the RI. Do you see something? Do you see? Do you see something from the CAPM formula I just show you? Bum, bum, bum. Do you see something? You say nothing. That you understand everything. Do you see something? Do you see something from this formula? Do you see something on the CAPM formula? Do you see something from the CAPM formula? No one answer me? Do you see something in this CAPM formula? Everybody can just have a look on the CAPM formula. Did you see the formula of CAPM? Do you see something? Do you see something? You say the expected return of stock is always higher than the risk-free rate. Yes. Do you see something? You answer nothing if you understand it. Okay. So it's just only my joke. So do you see something in the CAPM? If you understand, you say nothing. Anyone can type? Do you see something in the CAPM formula? Do you see something in the CAPM formula? You answer. You answer. Do you see something in the CAPM formula? You answer. You answer. Anyone answer? Wu Yen Hong Lin Biu. Do you see something on the CAPM formula? Wow. Okay. You say market risk premium. No, you still don't understand my joke. So you still see the CAPM formula. Yes, you see the CM formula. If you understand that the CAPM formula is allow us to calculate the expected return of the stock I, which is equal to the RF, which is the risk-free rate plus the risk premium for security I. The risk premium for security I can be computed by taking the beta of the security I multiplied by the market risk premium. Is it clear? So if it's clear, you understand completely what I just explained. I asked you, do you see something? You say nothing. Perfect. You understand my joke now. Okay, it means all the question related to the CAPM, if I say about market risk premium, the market expected return, and so on, don't make a mistake. Okay, very simple, straightforward. All right. So if you don't know how to compute the beta, so this is a formula for the beta. The beta represent the standard deviation of the RI multiplied by the correlation of the RI and RM divided by the SDRM. Okay, so it represents how sensitive of the returns of the stock I in relative to the market return. Okay, so this beta I, okay, if you know the correlation, you know the standard deviation of the volatility of the stock I and volatility of the stock of the market, you should be able to compute your beta. Why you need to compute your beta? Because beta will can allow you to compute the risk premium of that security I. Okay, and then obviously you can based on this. So therefore, the slide 42 is highly recommended. Okay, for you to mark it in your material when you write the exam. All right. So to do all these, I will not repeat what I've just said to you. If you have the portfolio where you have several stock in your portfolio, you can compute of your beta of your portfolio. When you know the beta, you're going to be able to calculate the expected return of your portfolio based on the beta of your portfolio. That is a kind of like the fourth part of these chapters. So it is clear. So in this chapter, what you need to know is first, they have four things you need to know. One is how to compute the portfolio returns and portfolio risk based on the, for example, the two risky asset stocks or two assets, two stock portfolio. So the formula you should know how to compute all these, and then you know the efficient portfolios, you know how to calculate the Sharpe ratio, and then you're gonna be able to compute or apply the concept of the CAPM. Okay, the CAPM would allow you to calculate expected return of the stock I, that often we use it as a proxy of cost of equity capital. Okay? That we often use the CAPM, okay, to derive the company cost of equity capital. All right, so far so good. So I'm done with the chapter 11. Okay, I suggest you to go and check your problem set that related to this. You have several questions related to that, and the exam will not very far from what you have seen it in your problem set. Okay. The next is about the estimating cost of capital in chapter 12. It's very straightforward and super easy in this. Okay, as you know that firm has different way to raise capital. If firm they raise capital or use capital only by equity, you can have a firm which is called unlevered firm. It means firm that has only equity in their balance sheet. So therefore, the weighted average cost of capital would be equal to the equity cost of capital. Okay. However, if firm has debt, obviously, and then you have to calculate what would be the asset cost of capital of this company, and this company we gonna calculate the asset cost of capital in the form of the RWAC, and the RWAC will gonna be equal to the fraction of the firm value financed by equity multiplied by equity cost of capital plus fraction of firm value financed by debt multiplied by the debt cost of capital. Okay, which is this formula. Okay. So very straightforward, this chapter. So you calculate. The only thing that is often make a mistake in the exam is about that we talk about here the D and the E, we refer to market value. Okay, we don't use the book value. The D should be the market value of debt. The E should be the market value of equity. Okay, you have some exercise that show you how to compute the market value of equity and market value of debt. Okay, it is very straightforward. Next, it's gonna be how we calculate the RD, how we calculate the RE. All right. So the way we calculate the RD, okay, we calculate in two ways. Okay. The first one that we compute is we calculate the RD based on this slide number 15. As you can see that the RD will gonna be equal to Y minus PL. Okay, Y represent yield to maturity, P represent probability of default, and L represent the expected loss rate. Okay, so you make this formula to compute your RD. Okay, so normally in the exam, all these numbers should be given to you. Okay, so and that is the first way we calculate cost of debt. The second way we calculate cost of debt is based on something called the CAPM formula, and this CAPM that usually we use to compute the cost of equity, isn't it? However, if you are able to compute the beta of debt, which is very hard to estimate this, but once you are able to do so, in general, the debt beta should be lower, higher than the equity beta, should be lower, right? So if you are able to compute the cost, the debt beta, and then you can borrow the CAPM to compute the cost of debt capital, okay, the RD based on the debt beta. All right, so you have two ways to calculate it. The example of problem that you may see in type of exam where I give you some information for both, and then you can use different formula to be able to compute. So this one you can revise it. Okay, and then you have the cost of preferred stock. It's very straightforward. If you have the preferred stock, and you're gonna be able to calculate the dividend yield for the cost of preferred stock capital. Okay, and then when you have the cost of equity capital, you have two ways to do so. The first one is the CAPM, the CAPM. Obviously, you can just simply apply the CAPM that we just discussed. And second, we use the fundamental approach, or we call the constant dividend growth model. We call the Gordon-Chapro model. So you can compute the cost of equity capital based on the dividend yield, which is dividend 1 divided by the PE plus the G that represent dividend growth rate. Okay, both way you're gonna be able to calculate the cost of equity capital based on capital asset pricing model or based on constant dividend growth model. Once you have all these, you're gonna be able to compute the weighted average cost of capital. Okay, and also a very important one in the real world, the interest part that you pay to the lender or the bondholder is tax deductible. So therefore, your effective cost of debt after adjustment of this interest tax shield will gonna be equal to the RD multiplied by 1 minus tax rate. Okay? In other words, that the RWAC can be reduced in the imperfect capital market where you enjoy this reduction due to interest tax shield the company has. All right. So to conclude, this chapter is only to introduce you how we compute the weighted average cost of capital. That's it. Very straightforward. All right. In case we can calculate the free cash flow for equity, total the fund needed, and the rate of work, we can recalculate the weight of debt and capital need to funding. Debt is bond and capital is stock. Each issue more. How can we optimize and what we need to analyze in the debt planning and dilute the EPS? Very good question. First of all. Second of all is I will read. carefully. We can calculate the free cash flow for equity, total the fund needed, and the rate of WACC. We can recalculate the weighted of debt and capital need to funding. Debt is bond, capital is stock, it issue. How can we optimize what we need to analyze in the debt planning and diluted EPS? So I would guess that this question you are discussing a lot on the uh, valuation. Most of this is in valuation classes. First of all, this type of question you would not have it in your exam. Okay. Second of all, and hope that these kind of question you are did you study with the evaluation class? Do you have evaluation class already? Not yet. So I suggest that these valuation or the question you're talking about here, when you have the financial modeling, where you have the free cash flow for equity, or you have firm free cash flows, and you can discount it with the cost of debt, cost of equity, unlevered cost of equity, or levered weighted average cost of capital, you should see it again in your valuation class. Okay, it's more complex to explain you on today's slides or today classes. It's okay. Chi Dung Guyan, can you give some keyword for us to evaluate? Mm-hmm. Uh, what can I give you in term of evaluation? Can I come back to these is afterwards? Let me revise some of those concept to everybody who who are preparing for the exam. Is okay? All right. Okay. Perfect. So let's go to these. Any question on how we compute the this chapter is basically we compute the WACC, the RWACC, okay, based on the firm cost equity, the RD with the two-way, and then the RE. Don't forget that the D is cost of debt. D is the market value of debt, and E is the market value of equity. So, and the rest is super straightforward. Okay. Perfect. So let's go for could you please instruct on question number 9 of problem set on WACC assumptions? Have I given your answer of the problem set? Let me check. Mm. Do we have oops. Do I have the exercise? Okay. Question number 9. So the question number 9 is about that the when you are going to use the firm cost of capital. Let me use firm cost of capital. Okay. as a proxy of what is a firm cost of capital or the company cost of capital that we measure in the form of weighted average cost of capital. Okay, weighted average cost of capital or firm cost of capital represent the asset cost of capital of the company. You understand what the asset cost of capital or firm cost of capital? Everybody follows? Yes? Okay. If a company has several risky assets on the left hand side of their balance sheet, okay? Because what is a company? Company is the accumulative type of investment decision that the company have been made, okay, in the past until today. Okay, they may have some several risky assets in their balance sheet. So what we are calculating is to see that what's going on the right hand side, what is the required rate of return to the debt holder and the required rate of returns of the equity holder. One, they blended, we use is a proxy of the assets cost of capital of the company. The question that we ask here that what if you want to use the WACC to as a proxy of projects cost of capital, right? So which is very tricky because many people use it naturally or automatically that it can be wrong, completely conceptually can be completely wrong. You can use only if what? You can use only if the you assume that the average risk, or we assume that the market risk of the project is equivalent to the average market risk of the firm. That makes sense? You can use it. However, when you use it, it means that you assume that the project risk, the market risk of the project, is the same as the market risk of the firm, right? So meaning that the beta of your project, you assume that is equal to the beta of the assets, okay, or the market risk of the asset. That is the first assumption you make. The second assumption you make is that you assume that after taking this project, the debt to equity ratio or the capital structure does not change. Thirdly, you also assume that once you borrow more for your, when you have these project, you have no effect on leverage based on these, new, meaning that if you increase your debt, your cost of debt should not change, right? So therefore, these are the major assumptions you make when you use the company's weighted average cost of capital or the WACC at the discount rate for evaluating the project. Okay, I told you in the class, for example, if Intel is planning to build a new chip factory, in the US, where the Intel use the WACC of Intel as the project's a discount rate for the calculating the NPV of the new project, it seems to be acceptable because Intel average risk on their asset is likely to be the same as the risk of the new project. However, if you are what? You are in the real estate company, okay? Wincom, right? So if you are planning to have the retail project evaluation because you're going to do some retail business, okay, along new line of your business, can you use the real estate weighted average cost of capital to discount your retail convenience store project? The answer would be yes or no. Can you use the Wincom capital WACC? Can you use the WACC of Wincom or the real estate company? Same company, but because you can have the portfolio of the company at the moment where the work of the assets can be completely different from the work of the project, okay, or the risk of the project. In that case, it is not good to use as the project of the project risk. Okay, so do I answer your question, Duke Lim Bui? Duke Liam Bui? Yes, okay. Thank you. All right. My last but not least, okay, I probably need only 10-15 minutes more. So I'm gonna talk a little bit about the capital structure and the payout policy. So the capital structure theory, what are the major ideas that you need or are the concept that you need to know for your exam? Okay, the first one we call the capital structure in perfect capital market. Basically, what you need to know is the Monin-Miller proposition number one, where and also Monin-Miller proposition number two. Okay, so what is a obviously, this one I can go and show you one more time, but you can do it by yourself. Okay. What the proposition says, they say about that the A should be equal to the U and U should be equal to the D plus E, meaning that the imperfect capital market, the total value of a firm is equal to the market value of the total cash flow generated by its asset and is not affected by the choice of capital structure. Remember, I give you example when Professor Monin-Miller got the Nobel Prize. He explained to the press saying that what is their proposition. They just give you example of the pizza, where the pizza, once you order the small size, medium size, or large size, no matter you cut it into two, you cut in four, you cut in eight or six, the size that of the pizza order would not change, right? You can still keep and have only same pizza that you order. Okay, so the A should be equal to the U and U should be equal to the D plus E, and that's it, what it says. And then they say that the proposition number two saying that the cost of capital of lever equity is mean lever equity investors, where they invested in the company where the company has debt, okay, or the company has leverage, they're gonna require the extra risk premium, which is equal to the D over E multiplied by the RU minus RD. So it means like the RE should be equal to the RU when the company has no debt. But when they have debt, the RE should increase because the risk increased, okay, to the lever equity holder. And Monin-Miller proposition number two just simply say that the risk, the extra risk, they gonna need or we're gonna be equal to the D divided by E multiplied by the RU minus RD. Okay, I suggest you to revise a little bit on that and try to understand how the work should be equal to the RU equal to the RE and so on and so forth. Okay, and that is something that you can see from this problem that when you change your capital structure, you should be able to compute, for example, deleveraged firm, cost of capital, those kind of thing, or when the cost of capital change. Okay. Remember when I do the exercise with you, I suggest you to read and then you write. Okay. After you write, you can draw. Okay, and then obviously the calculation is simple. For example, this company, what to write? So El Paso Corporation is natural gas firm with market debt equity ratio of 2. So D over E equal to 2. Suppose current debt cost of capital is 6%, RG equal to 6%, equity cost of capital is 12%, RE equal to 12%, and suppose issue equity use proceed to the D over E equal to 1, it's gonna lower its debt cost of capital. RD new we're gonna be 5.5 in the perfect capital market. What would be the RE? So basically, you can simply use the Mordin-Miller proposition number 2. You have to calculate the RWAC first, and RWAC should not change in the perfect capital market, and therefore you're gonna be able to solve all this. Gonna be able to calculate the beta of the lever and unlever beta, and then obviously this one is just only something that you should know. I told you already, if I understand correctly, that all these slide on the earning per share, all these you can skip it, right? This one will not be examined. Okay, it will not be. I think already taken from your slide. The next, which about that what's going on if the company can enjoy the tax deductibility of interest rate when the company has debt. Okay, so we introduce this and then we ask you to compute the interest tax shield, and this interest tax shield we're going to be equal to the top corporate tax rate multiplied by interest payment. And if you calculate the present value of those interest tax shield, we're going to be equal to plus the VU, which is the unlevered value of the firm, we're going to be equal to the lever value of the firm. In this formula, what it says, it says that the value of the firm in the imperfect capital market where the company can enjoy interest rate tax shield, we're going to be able to maximize the firm value by obtaining benefit from interest tax shield. Okay, and the total of interest tax shield should be equal to the present value of all interest tax shield you're going to receive over time. All right, so and this is how to calculate the present value of interest tax shield. This is the another revisit of the cap of the WACC formula. Then we argue that the benefit is not come alone; it's come with associated costs, and the cost that is very obvious is about financial distress costs, and the present value of financial distress costs will offset, okay, with the interest tax shield. So therefore, this theory we called it as a trade-off theories. The trade-off theories, okay, allow us to understand how you can trade off between the benefit of interest tax shield and the cost of financial distress. Okay, the idea is try to find an optimal portfolio choice, and the optimal portfolio choice represent the highest of the graph, where you have the D star that represent the optimal capital structure that you can maximize your firm value of the VL. All right. So you have some additional costs like agency costs, and then you have some other benefits, and so on and so forth. So this chapter is basically what you probably expect me or you expect to have some computation or problem solving in the perfect capital market, okay, where you're gonna have some conceptual questions when I ask you to check your understanding with the trade-off theory and so on and so forth. All right. Any question? My last but not least is about the dividend policy. Dividend policy is completely simple. Your long-term financing would gonna be only conceptual question, huh? No, no, no computation. You would see the dividend policy. I think the most important one is about the choice between paying cash dividend and share repurchase. Okay, the important one, I would think that it should be this slide. Let me see. Oops. Tuk, tuk, tuk. I have something. Oop. Okay. So I think this is a summary of the slide that you should see here. It's a very straightforward. Again, this one is just represent that when you pay cash dividend, okay, and the effect on the share price is that the share price should drop by the amount of the dividend paid out. When you do the share repurchase, the share price is unaffected as long as shares are repurchased at the fair market price. Okay, and Monty Miller saying that in the perfect capital market, no matter that you pay in the form of cash dividend or you pay share repurchase, the value of the firm should not be affected. Okay, and that's it for these dividend policy. You can just have a look on the slide one more time to see how do we compute the share price and why the share repurchase there is no effect on the share price. All right, and the last one is just only that I invite you to read a little bit on the long-term financing. You should know what is the venture cap, what is the angel investor. It's gonna be a very general, conceptual question that I would like to ask you. Okay. All right. That is what, Professor, can I ask the last year exam to get familiar with the exam format? Unfortunately, I cannot, unfortunately, I don't have the last year exam to share because the format is different. I try to avoid not to make you confused and do something that is completely irrelevant to your exam this year. So I suggest you that this year exam, we're gonna do online. So therefore, you can have some conceptual questions that I ask you. We measure, market risk by the volatility of the stock, and you say fault like that. Okay, very simple, straightforward. And then when you have the problem solving questions, you're gonna have some question that related to almost what you have seen it in your problem set. Okay, I promise I gonna make easy exam. I gonna make it also relatively easy, and then I gonna is an open book, I guess, and then I gonna have question that correspond to your limit time of 2 hours. All right. You have time? Do you still have the list of students who make the beta of stock exercise to have one bonus point? All right, this is true. I have them. Everybody submit the beta for 1 point bonus. I have based on what you send it by email. Okay. Yes. Okay. You send via email. I got it. Okay. Some of you have calculated for me. Some of you did not. Okay. The people who did send those to me, thank you for reminding me. You get one bonus point. One bonus point for beta calculation. Many thanks. All right. So I wish you all the best. Do you have any other questions? It is clear you have problem set. You have the how we call the answers of those questions. Yes. Okay. I hope to see you very soon. I hope Vietnam or they allow me to travel. If I can, I would love to see you in person in Hanoi or Ho Chi Minh when I have a possibility to travel to Vietnam. Vietnam, I miss it a lot. So I hope to see you very soon. Okay. I hope to see you to. Are you coming in May or you are coming for the Europe trip? I don't know who I gonna meet you first in Paris or I gonna meet you. No, you don't have due to the COVID constraint. Yeah. All right. So if you don't have any further questions, I wish you all the best. I will finish the session today now, and I wish you all the best. We take more classes credit to compensate for the study trip. Okay, so hopefully we're gonna be able to travel freely and the COVID is gone. We are fed up on the COVID. We use MM1 when we use MM2. The MM1, we use it when you do the A equal to U equal to the D plus D. So most of the time we use the MM2 to calculate the RE, right? We often use the MM2 in the calculation than the MM1. Okay. Any other questions? So I wish you all the best for the exam. Okay, and hope to see you. So for both are still in the perfect capital market, right? All these are perfect capital market. In most of the calculation, I can ask you, we're gonna be based on perfect capital markets. Okay. Any other questions? Good luck for your exam. Okay. I will I will let everybody pass. If you want to get 20, just write to me, I give you 20. No, it's a joke. You want to get 19, it should be fine. Or you get 20, I can have 20 in the past exam. So, okay. Thank you, sir. Thank you also, you guys, to spend evening with me. I know that you are also busy and take care of your kids, take care your family, and stay safe from COVID. And you need to 19.5. Okay, I give you 19.5. T Julian Guyan. Okay. So everybody, somebody said you need only 10. No, you should get more. Thank you very much to you all. Very happy to see you. Very happy to teach this course and continue to have this course with CVG students. And I wish you all the best and enjoy your evening. Have a good night. And on the 24th, you can have the exam with me. And then good luck to all. Bye bye.